Welcome to this Handtech Markets video on candlesticks. Presenting prices in the form of candlesticks originated in the Japanese rice markets in the mid-1700s. Although they were reportedly used by Charles Dow around 1900, it was not until the 1990s that they became well known in the West. This followed the publication of a book written in English by Steve Nissen called Beyond Candlesticks. When you first open your MT4 trading platform, the charts will probably look like this one. In order to show the prices as candlesticks, you need to click on this icon in the menu bar. After doing that, you might find that you need to zoom in a bit so that you can see the individual candlesticks more clearly. The default setting on MT4 is for charts to have a dark background with the candlesticks having a green outline. The body of a bearish candle is coloured in white, while the body of a bullish candle is coloured in black, although it may appear to be empty or hollow. We will explain these terms in just a moment, but before we do, let's have a look at changing the colour scheme. To do this, just press F8 or right-click anywhere on the chart and then select Properties from the bottom of the pop-up menu. Here you can see there's a drop-down box above the chart labelled Colour Scheme. If you click on this and then choose one of the options, let's go with black on white. And we'll click OK. Now you can see that the candlesticks have a black outline on a white background. Furthermore, the bullish candles now have a white body and bearish candles have a black body. If you want to, you can customize this further by making your own color choices. For example, if you wanted to, you could set bullish candles to be green and your bearish candles could be, let's say, red. It's entirely up to you, so long as you remember which is bullish and which is bearish. Although a candlestick chart looks quite different to a standard bar chart, the data it represents is exactly the same. We're still looking at the open, high, low and closing prices, but in a slightly different way. The price band between the opening price and the closing price is represented by the wide portion of the candlestick known as the body. If the high and or the low extend beyond the region of the body, they are represented by a line known as the shadow or the wick. There are a huge range of candlestick types and patterns, far more than we could hope to cover in a 5-minute video. While we will introduce some of the most common patterns here, those wishing to use candlesticks in their trading would be advised to research this area further. Marubozu candles are usually relatively long candles that close at the extreme high or low price for the period. Bullish Marubozu close on or very close to the high price for the period, while bearish Marubozu close on or very close to the low price for the period. Spinning tops are candles that reflect indecision in the market. They are characterized by their relatively small bodies and comparatively long upper and lower shadows. This shows that although prices covered significant territory during the period, neither the bulls nor the bears were able to take control, and prices ended up closing roughly where they were at the start of the period. The hammer candle has a relatively small body and small or absent upper shadow with a long lower shadow. When this candle appears in a downward trend, it is often regarded as a sign of potential trend reversal from bearish to bullish. If a candle with the same approximate construction appears in an upward trend, it is known as a hanging man and is also a signal of trend reversal, this time from bullish to bearish. Doji candles come in many varieties, with the common thread being that the opening and closing prices are at the same level, or at least very close. On the left of this diagram you can see a 4-price doji where the open, high, low and close are all at the same price, indicating a distinct lack of interest from market participants. On the right of the diagram are several long-legged dojis, so named because of their long upper and lower shadows. Two special types of doji are the dragonfly doji and the gravestone doji. Each of these is considered a sign of trend reversal. Look for the dragonfly doji at the end of a downward trend and the gravestone doji at the end of an upward trend. Other candlestick patterns are made up of 2 or more sequential candles. Patterns of this type must always be considered within the context of the recent trend. Some of the most common ones include the engulfing patterns and harami pattern. You may also see a piercing line or dark cloud cover pattern. As you can see on this diagram, these reversal patterns appear where a trend initially extends strongly in the prevailing direction before the new highs or lows are rejected and prices snap back in the other direction, posting a strong counter-trend close. Other signals to look out for include the 3 black crows and the 3 white soldiers. As the name implies, these patterns are made up of 3 relatively long candles. They move in the direction opposite the previous trend and indicate the emergence of a significant move in the other direction. Finally, this diagram shows how it is possible to combine multiple candlesticks into a single candle that has the same implications for price action. Here you can see the way that a multi-candle bullish engulfing pattern can be collapsed into a single hammer candle. Both these signals have a bullish implication for prices. As you learn more about candlesticks, and in particular candlestick patterns, you will realize the importance of gaps, overlaps, and the difference between the opening price of one candle compared to the closing price of the previous candle. Because there are very few gaps in FX prices, some patterns are going to appear a lot less frequently. Despite this, using candlesticks can give you insights that are much more difficult to acquire when using a traditional bar chart, so it is definitely worth learning more about them.